All right, without further ado, I will pass it over to Dave Codray to begin our discussion.
All right, thank you very much, Dominique. Excited to talk to everyone today about this deal. This one was a big one for us. It was the first deal that we purchased in South Carolina, all the way back in 2014. So it seems like a long time, it was a long time ago. The price, we bought it for just over $3 million. And it's, a mile from downtown Spartanburg. We're very excited about this deal. We always have been. You can kind of see some before and after pictures. We fully renovated this deal. We replaced all the windows. We did all the siding. The deal looks excellent, and it's been well maintained for many years now. Over the life of this deal, we're going to get into a little bit of kind of where we're at with it right now, but we're always assessing what's the best way to either operate a deal, or how are we holding it, or how are we financing it, and what does that look like? So just here, 2017, we made a distribution because we refinanced it, and we put long-term debt on the deal at that time. But over the life of the deal, we've only made distributions from cash flow in 5 of 30 quarters. So I know we have had some issues with distributions here, and they haven't been consistent. But overall, we did do a big distribution in 2017 from a refinance, and the other distributions of preferred returns happened over these quarters, most notably 2017, and then a big chunk in 2019 as well. So if we're looking at the deal now, we go from 2014 and we bring it up to 2021, and the condition of the market that we're currently in, we're always looking at our deals on an annual basis, and you can see even on our cover sheets that we have, we're putting in there what kind of market cap rates and values of a deal are. This deal is worth roughly $14 million right now as it stands. We have $920,000 of remaining equity in it. That was from the original investment check of around $1.5 million. We returned $615,000, and now we've got just over $920,000 left. With our current loan, you see this fairly exact number. This is our balance when we did our refinance back from 2017. And so that puts us at an equity valuation of right around $8.5 million that we have in this asset. So we have a huge amount of equity that is sitting here. And then when we think about our opportunities, we have always opportunities to either hold an asset, and we have an opportunity to sell an asset really at any time. We try and use as much objective decision making as possible when we look at these scenarios. And then Josh and I are normally sitting down and discussing, where do we see the market going in this city or overall, or how does this asset fit into our operational plan? Does the operational team come back to us and be like, man, this thing's a pain in the butt, or they really like it? That weighs heavily on kind of how we determine our long-term plans with deals. So you see some key points here. If we do a refinance, it's got to hit all these bullet points at the bottom here. That's really what we're looking for, to make sure that we're consistently making the right decision on holding an asset. In the case here, we're at 4.75% right now on our debt. We could probably lower that to 3.75. The 10-year treasury, all these rates are based on the 10-year treasury. It was lower about a month ago. It's creeping up a little bit, but we would have a pretty substantial savings on our interest rate. And our NOI, we're looking at really loans are really only looking at trailing 2 or 3 months. So you're taking 2 or 3 months to annualize that out for a year. And our numbers right now would support $6.9 million in debt, given the current interest rate, maintaining a debt coverage ratio of 1.25. That's how we get to that. We could theoretically go out and get a $6.9 million fixed rate loan to replace the one that we currently have. So if we look at our analysis of what would a refinance look like, we'd be able to pull out $6.9 million in new debt. We'd pay off our current loan. We'd have roughly $200,000 in closing costs. And then we have roughly $2.1 million of capital that we can then apply to the equity stack. If we're doing that, we're going to have some capital improvement holdback. And again, this is predominantly coming from the lender. Every time we do a refinance, this comes from the lender, their inspections. We don't get to sway that number too much. They're not really asking us our opinion. They're doing their inspections and determining what a holdback is. So we always buffer for that. We'd have our $922,000 of existing equity that could be returned, deferred prefs. And that would leave us with about $740,000 of profits if we go out and get a $6.9 million loan. Other aspect of the scenario is now, okay, what if we sit down and sell the deal, right? So we're comparing here what our two options are. If we sold it at our current market price of this $14 million, we'd be able to pay off our loan. Our closing costs, we still have closing costs with the refinance. They're a little bit higher on the closing because there's more brokers involved, but that leaves us with just over $9 million available cash. We pay off the existing equity of $922,000, the deferred pref, and now we're left with $7.9 million of equity. That's a pretty huge gain, considering 2014 we bought this deal for $3.1 million. Now saying, hey, it's worth 14. We have $7.9 million of equity built up in this. That'd be a 26% IRR over a 7-year period and an over 5x of everyone's investment dollars that are in this deal. So now we're thinking, okay, we have this option, we can hold it, we can refinance it. Josh and I are very much both long-term holders of real estate, and that's our goal. But another part of that is cash flow. We want to be able to produce cash flow. And then we look at the sale option. We can generate 10x the current cash flow, right? We can free up about $8 million of equity versus $800,000 on a refinance from the profit side. And we could use that to go find cash flow. So we have two aspects here, the pros and the cons of a refinance or a sale. Right? So on the refinance side, there is the tax aspect. We're not paying any taxes on a refinance. And the property is currently, it's in very good condition. And we're seeing rental rate growth of around 8% a year. That's pretty solid right now. And there's definitely growth left in the residential space. So rents are going up. The cons, though, there's always risk with holding assets. We're normally fine with that risk, but our assumed basis, if we say, hey, this deal is worth $14 million, we get a loan at that amount, that's going to be one of the highest basis positions of a multifamily asset in this market, in our condition. So that's a little bit of a risk there. And we do know for a fact, like I mentioned, we struggle a little bit right now on cash distributions. With a new loan, it's going to obviously cost more. So we would know that we would not be able to make any distributions going forwards. When Josh and I are looking at stuff, and if we can't make cash distributions, that's what we're in business for. That's what we want to be able to do, is make those cash distributions. So these cons aren't weighted, but that's a pretty heavy one in our minds when we're looking at a deal. And then also we have a lot of equity sitting there still in the deal. Now, on the sales side, same thing. There's pros and cons. Pros, obviously, get a really big check. $8 million of free profits is a lot. And we'd be able to utilize a 1031 exchange on this deal. And we can go deploy that into assets right now that we know are creating better cash flow than we're experiencing now. So we see that as a very good opportunity on the pro side. And on the con side, out of a growing residential rental market, but we see that being countered pretty heavily by the lack of distributable cash flow. So if we look at these two things together, we're very much in the camp of that we should look to sell the Hillcrest asset, and we should look to take those funds and reinvest them in another opportunity, utilizing the 1031 process. We know that I believe it's the end of this week that we're going to have some new information with the tax policies that are coming through, and we know capital gains are going up. We're assuming that right now, so that's why the 1031 is a critical component of that, and making sure we're not getting hit with any big tax burdens. But we also strongly believe that we'll be able to go get even better cash flow on the more of the equity chunk that we have that's available. If we go back and spread this deal out, it generated about 5% a year in cash flow from 2014 to 2021, and it only paid that in 2017 and 2019. So we had 2 years that were positive cash flow, and we know for a fact that we can go buy a asset in the current environment with really strong debt that will provide more consistent cash flow for our investors. So we're excited about that opportunity. It's not as clear cut as like we just sell it, buy it. It doesn't work that way. You all know that. So upcoming, we're going to have in middle of October, we're going to have some idea of what our 1031 options are. We have some really good deals that we're currently lining up right now, mainly in that medical or the government space where we have fixed debt for a long time and set rental increases for a long time as well. So we're excited about those deals, and the spread in that market is much higher, right? The spread of the cap rate to debt is much higher than in the residential market right now. So we like that part. If we're able to go through all this stuff, our targeted closing for the Hillcrest asset would be towards the end of November. And in the past, we've been pretty darn quick about the ability to identify and place our 1031 funds, so there's not like a huge gap in investment period. 30 days is definitely aggressive to say we get it done by the end of December, but we think we can get this replaced very quickly with cash flowing assets. So